and welcome to Sectors Up Close. I'm Elena Casas. Today we're talking US healthcare, and my guest is Amy Kong, CIO of Barrett Asset Management. Healthcare stocks are a classic defensive ploy in a bear market, but the sector is actually a mixed bag, ranging from biotech firms and drug makers to equipment suppliers and insurers, some areas being more cyclical than others. Well, this is the S&P 500 Healthcare Index, down about 8.5% this year. It's outperforming many of its rivals. The biggest constituent here is provider United Health Group, followed by pharma giants Johnson & Johnson, Eli Lilly, Pfizer, Merck and AbbVie. The pharmaceuticals subsector is down just 5% for the year, but biotechnology is down almost 30%. So, how can investors make healthy choices in this space? To find out, I'm now joined by Amy Kong, CIO of Barrett Asset Management. Amy, hi. As I was saying, healthcare has been outperforming year to date, but now that we're in a wider bear market, does it still make sense?
Good morning, Elena. Thanks for having me. I can envision two scenarios playing out towards the back half of this year. First is if inflation stays stubbornly high, we could probably see a repeat of what we saw in the first half. And in this scenario, healthcare could extend its leadership. Secondly, if inflation starts to moderate to a acceptable degree, what we can see is some of the other beaten down sectors rally, and healthcare will likely rally, but probably not to the same degree.
Let's break it down then to different sectors within the healthcare space. We see big differences in performance between, for example, the big pharma giants on one side doing pretty well and biotechnology companies. So how would you explain that?
Sure. Large cap pharma is, to your point, defensive. And more recently, they've been showing some growth aspects with regards to spin outs and some M&A activity. So there's a little bit of excitement there. In general, these companies offer very good cash flow, higher than average dividend yields, which I think market participants are liking in this kind of choppy environment. The biotech sector is also exciting, but to your point, it is a little bit choppier, just given that some of the small and mid-sized companies could be less profitable and in some cases not profitable, something that investors are not liking in this environment. And they probably lean a little bit more towards M&A to to kind of live up to that momentum, and that momentum is not quite there right now. So going into the back half, into potentially a recessionary environment, the large cap pharma space is, in our opinion, quite attractive.
So how would you pick and choose within the healthcare space? Is it really large cap pharma that's the best part of this sector, or are there other good points that you see?
Sure. We like a number of large cap pharma. We would actually pair that with biotech, but we're being very selective, leaning more towards the larger cap biotechs that have better balance sheets, free cash flow positive, and just the ability to be more independent in this kind of environment. Within the healthcare space, we're leaning away from med tech, which has been struggling quite a bit just in light of patient volume still trying to come back to pre-COVID levels. I think the hospital setting remains challenged based on labor dynamics and things of that sort. So we're shying away from that sector a little bit. You mentioned insurance. The managed care organizations are, in my opinion, in a very good spot. There's been a nice wave of consolidation in that space over the past 8 years, which gives them the ability to benefit from economies of scale. And then, of course, there is that long-term dynamic of healthcare that's really being a tailwind for them. So they are still benefiting from Medicare and Medicare Advantage enrollments, which we don't think should slow down in the next couple of quarters.
In the medium term, though, the US is, of course, heading towards midterm elections in November. What does that mean for healthcare stocks?
I think in general, when you look back to midterm elections, it's been a tailwind. I think going into this midterm elections, that could still be the case. I'm no political expert here, but what I can say is that by November, we will see 35 seats within the Senate up for re-election and all seats within the House up for re-election. What this may mean is it gives the Republican Party a chance to claim a majority in either part of the Congression. And so in that that case, that can actually be a plus for healthcare, because if there is a split Congress, it probably means that less probability of policies being passed that could be detrimental to healthcare, and generally speaking, that could be a tailwind.
Well, thanks so much for that analysis, Amy Kong, CIO of Barrett Asset Management. Well, before I go, here are some of the stories we're following in this space. Merck is in advanced talks to buy cancer-focused biotech company Seagen in a deal that could be worth more than $40 billion, according to the Wall Street Journal. The companies are discussing a price of over $200 a share for Seagen, which closed on Wednesday at $175. Democrats in the Senate are advancing a deal that would allow Medicare to negotiate lower prescription drug prices and potentially lower government health costs by billions of dollars. Some of the most expensive drugs frequently prescribed to older Americans, like treatments for cancer and arthritis, would be covered by the deal. And the FDA said on Wednesday it will allow pharmacists to prescribe Pfizer's COVID-19 pill Paxlovid to increase access to the treatment. So far, fewer than half of the nearly 4 million courses bought by the federal government have been administered, but case numbers are jumping again across the US. And that's your roundup of the US healthcare sector. I'm Elena Casas, and this is Reuters.